Good morning. This is Dylan Joe with Behind the Markets. Happy Tuesday. Today is Tuesday, July 28th. What a blessing it is to be back with you folks. Today, I'd like to talk about what's happened in the markets while I've been gone, or where we are actually right now and what it means for where we are right now. Those of you who've been longtime viewers of this channel know that I like to think about the world in terms of split screens. And here we have a great split screen scenario. On one side of the split screen, while I've been away, I've been focusing on interest rates. That's one side of the split screen. And the bond market was flashing red. There's no doubt about it. Remember, we've talked on this channel a long time about the 10-year bond yield, how important the 10-year yield is to stock investors, not just bond investors, but to stock investors, to you, to your retirement, to your portfolio. It matters. The 10-year yield is like a seesaw. 10-year yield goes up, stocks go down. 10-year yield comes down, stocks go up. And the market was selling off while the 10-year yield was marching up because of the Iran war. When I left, the 10-year yield was at 4.40%, and last week it was at 4.7%, which was the first time it had hit that high since, well, actually, you know what? To put it into context, that was the highest it hit. It even got above the so-called Liberation Day highs of the 10-year yield in April of 2025. So that really put a lot of pressure on stocks. When that yield, that 5% level for the 10-year is like a ceiling. The stock market is not going, with the current set of facts, is not going above that. It's just going to push it down. Remember, interest rates, yields act as a gravitational force that impacts stocks. The yield gets above a certain point, it pushes stocks down. Yield goes down, it pushes stocks up. Okay, it's the price of money. And the Iran war has really been controlling that. When that heats up, and it looks like we're going to pay more for oil, which sends interest rates higher, that puts pressure on the market, sends yields up, puts pressure on stocks to go down. That's one side of the split screen that really matters for an investor, for a stock investor, for sure, for any investor, really. The other side of the split screen are profits, corporate profits. And I'll tell you something, I was thinking about this while I was driving around this great country of ours, looking at landscapes, looking at sunsets, sunrises, just unbelievable. By the way, if you go to the Grand Canyon, stay at the Bright Angel Lodge. It is as good as people say. We stayed there. We have these little lodges, and literally, 10, 15 feet from the back is the Grand Canyon. It's like your backyard is the Grand Canyon. It's just one of the most amazing things I've ever seen. Anyway, the profit side of the split screen here, the AI boom has had a few distinct phases, profit phases so far. The rest of it's just hype. Let's put that aside. The initial big profit phase was the initial NVIDIA boom. All of a sudden, everybody's buying these NVIDIA chips. NVIDIA just goes right up, And Palantir went crazy too. The second is what I've started derisively calling the Mag 7 buying $1 trillion worth of everybody else's stuff boom. The Mag 7 starts and the hyperscalers start to build this massive infrastructure. And they start to buy AMD chips and Micron chips and these chips and ARM and all those other chips from all these other suppliers. So they start to go boom, right? They just go crazy. So NVIDIA is the first, NVIDIA and Palantir, believe it or not. And then all of a sudden, the suppliers start to boom. Now Intel's getting in on the party. It's unbelievable. So that's phase one, then there's phase two. Now we're entering a different part of the story, which I'm going to come up with a funny name for. But right now, basically, what it is the margin expansion boom. And I say this, a great little note out from Morgan Stanley, talking about the focus here for them is they're looking at all the companies that are integrating AI and what they're seeing. And they're talking to Bank of America, Halliburton, CVS, NextEra Energy, all the companies. And what they're saying is we study these companies, and these companies are telling us we're starting to expect basically about 100 basis points of margin expansion in companies, S&P 500 companies, that really integrate AI into their business operations. This is a big deal. Big deal. Just integrating, we're starting to see companies are starting to get that return on investment that has had so many people concerned about this AI boom. I have told you that in addition to being an investor, I also own this business, and we have been integrating it, and we have been seeing success integrating it here at Behind the Markets. I have suggested and advised other entrepreneurs watching this channel that you integrate it as quickly as you can because your competitors are. Might as well get a jump. Anyway, the point is the S&P 500, the companies that are disciplined and focused on introducing this technology, and I'll tell you what I say to my team, unless it helps return on investment, it's just toy. So the only thing we're going to be integrating in things that drive return on investment, higher returns or lower investment. Lower investment is through lower costs or faster execution. Anyway, my point is that Morgan Stanley's note says that what they're saying is 100 basis points in increased profit margins for firms that adopt AI. Now think about that. Total S&P profits last year was $2.31 trillion. The average profit margin in the S&P 500 is 15.7%. If you start to see that boom up, and that goes to 16.7%, maybe 17%, that is a 6 to 10% increase in bottom line profits just on AI adoption alone. You will see if companies start to actually report that their margins are expanding because they are adding and integrating AI, I am telling you, that boom is just going to ripple out to more companies and it's going to get bigger. Believe it or not, it will get bigger. So again, split screen on one side that keeps me very focused on is the 10-year yield interest rates, basically whether it's through the Fed, but right now it's about Iran. On one side, that makes me cautious. One thing that makes me optimistic is the profit boom that we're seeing with the S&P 500. Right now, I'm 60% more optimistic, bullishly than I am, but a 40% cautious, and that's about as optimistic as I get by nature. Anyway, that's all I have for you today. Have a wonderful day. I'll see you tomorrow.